Okay, ladies and gentlemen, welcome. Good afternoon. Welcome to this call to discuss Caledonia's results for the third quarter. In addition to the usual discussion of financial and operating results, we'll also discuss the preliminary results of the exploration program at Motapa, which we published this morning. And I'll also make some brief comments regarding the progress at Bilboes. I'm joined this afternoon by James Mufara, who's our Chief Operating Officer. He joined us in May. By Chester Goodburn, our CFO, and a new person, a new face, I think to most of you will be Craig Harvey, who's our Vice President Technical Services, and he's responsible for our exploration activities. So he will say a few words about what we're doing at Motapa. And then I'm joined by Victor Gapari, who's a director, and he will field questions relating to Bilboes and/or the general environment in Zimbabwe. Before we get into the presentation, I just want to make a couple of observations. The first is that Caledonia is changing very rapidly, and that's reflected in the three announcements that we published this morning. First of all, we've got the financial and operating results, which largely reflect the performance at Blanket. It's fair to say that production has stabilised from what was a difficult time in 2023. But we now need to address the issue of costs, and we are facing some stronger headwinds than normal, particularly in respect of higher electricity costs and labour costs, and the effects of continued currency instability. We are accustomed to managing these risks, and in the course of the presentation, we'll set out some of the steps that we've already taken to address these areas. And we'll also outline some other issues which at this stage it's too early to quantify the effect or indeed the timing of when they will come into effect. So we've got the financial and operating results relating to effectively Blanket. We've got very encouraging results from Motapa, which reaffirms and reconfirms our strategy of investing in Zimbabwe to create a mid-tier Zimbabwe-focused gold producer. And I think that strategy is now being vindicated by what we're seeing at Motapa. And clearly we'll continue the dividend. The third press release this morning was the continuation of the dividend. We have attractive and competing calls on our capital across the business, but maintaining returns to shareholders remains a key part of our strategy. So with that, we'll get into the presentation. Regrettably, sorry, just go back a minute, Camilla. Let me just deal with those. So yes, we had a fatality at the mine in late September. James will talk a little bit more about that. Just under 19,000 ounces of gold were produced in the quarter, a little bit less than we did in the same quarter of 2023. But let's just note that was a record production quarter. So we're very comfortable with a production run rate of just under 19,000 ounces, and we remain on track to achieve the full year guidance of anything between 74,000 and 78,000 ounces. As I mentioned, encouraging results at Motapa, which Craig will talk about in a moment. We've also announced the forthcoming sale of the solar plant. That's been operating slightly better than expected. We built it at a cost of about 14 million. We're selling it for just over 22 million. We will continue to get the power that's generated from that solar project. So we're by no means losing the benefit of getting that reliable power. And in addition, the new owner is now evaluating a second stage of that solar plant. So we can release the capital and use the capital elsewhere in our business. Already mentioned the fact that we've declared another dividend of 14 cents. And we'll talk a bit more about Bilboes, but we're continuing with the feasibility study, and we're making some progress now on funding options for that project. So moving on, I think, can we move on, Camilla? Or I think I've dealt with most of these things. I mentioned production, gold price benefiting from the higher gold price, an average price in the quarter of over 2,400. That's resulted in an improved revenue, improved gross profit. But at the net profit attributable to shareholders, as Chester will outline, we then suffered the headwinds of continued foreign exchange losses and some other unusual expenses, which Chester will outline in due course. So I think with that, we're going to move into the, yeah. So can I ask Craig, can I ask James to just run through the review of the operations at Blanket? James, could you do that?
Thank you very much, Mark. Good afternoon to you all. As Mark already alluded to, we regret to inform you that we lost one of our treasured employees, a JACAM assistant, on the 21st of September. The said employee was in the process of installing support when this fall of ground actually occurred, fatally trapping him. Despite all our efforts with the rescue team to try and bring him out to surface and resuscitate him, unfortunately, he succumbed to the injuries that he had suffered in this fall of ground. As an organization, Caledonia, we will strongly believe in a culture of care and growth, and this is something that we treasure ourselves with. We also believe in total or real risk reduction all the time, and we believe in learning from the incidents that would have happened. We have given the employees' family support, and we've also supported the government with the investigation that they actually took out with regards to the employee that lost their life. Subsequent to the accident, we actually employed the services of DuPont or DSS Plus to do a total diagnostic on our operations in order to see the whole of our value chain with regards to safety and health. This work, we believe, will assist us in our quest for zero harm on our mines, which we believe and totally and thoroughly believe that is both a moral imperative and an operational imperative. On the production of the quarter, I'm glad to announce that in terms of development, we actually came in 7% above, close to 7% above our plan for the quarter. This is good with regards to our future flexibility that we'll need, because the development is opening up our future possibilities of flexibility. In terms of tons, we're neck and neck with regards to what our plan was. However, we were set back because our grade was just around 4% below our plan for the quarter. This was as a result of a fall of ground that we had at the beginning of July in one of our stops in Roika, and we couldn't actually quickly and in time have the flexibility to replace this stop. As a result, we actually suffered this drop in our grades, in our assay grades. We have ever since moved back into better stops to stabilize the grade, but it was a little bit too late to recover the quarter at that moment. As a result of the grade drop that we had, we actually ended up with our ounces just on 6.9% below for the quarter. The improvement that we see in the development and the achievements that we see with our targets at the moment will ensure that in the future, we'll insulate ourselves from incidents of inflexibility that hampered us in the previous quarter. Thank you, Mark.
Okay, I think we'll move on to finance. Chester, can I ask you to run through these pages dealing with finance, please?
Yes. Thank you, Mark. It's good to see our revenue up by 13.6%. That's 28% due to additional prices or higher prices that we've received. Royalties remain flat at 5% of revenue, and production cost has increased by 2.9%. So it was good to see the cost of bulbos coming down, and also the revenues of bulbos covering the holding costs for bulbos. Production costs at Blanket has increased, and as Mark has said, we've got some cost initiatives to improve on that, and we'll get to that in a bit. And then depreciation has decreased, and that's due to lower ounces. I was quite pleased to see the gross profit at an increase of 37% for the quarter. When we look at the production costs, this is on a per ounce sold basis. You can see that the wages and salaries has increased, and that would be due to additional headcount that we've employed at Blanket, as well as overtime that we spend. And we've got some initiatives to turn that around. Consumables increased, predominantly due to once-off repairs and maintenance that we've done in our engineering and metallurgical plant, and that shouldn't reoccur. So I'm not too concerned about consumables. Other than that, repairs and maintenance charge, we can see that our prices are really good, and there's actually been a slight reduction in our variable consumable costs on a per ounce basis. Electricity has increased a blanket, and that's due to higher maximum demand charges that we are receiving. If you exceed a certain demand charge, or let's say electricity load at the mine's grid, the utility would increase the rates that they charge, and that increases the cost that we see here. In addition, they also levy a penalty if you have a low power factor that comes out of your grid, and that has also increased our electricity charges at Blanket Mine. But we've got some initiatives, and some of them have already been, or is about a week away from being implemented. On-mine costs and administration at the mine has increased, predominantly due to the rebasement of costs, due to the volatility that we've seen in the ZiG, and all your local suppliers have increased the costs, and we can see that effect of it. But it's not a big increase in absolute terms. Bulbos, I've spoken to that before. That's covered by the revenues, and that's on a break-even basis. If we look at the waterfall of our Q3 23 cost and how that compares to our current on-mine costs, we've decreased the cost significantly at Bulbos oxide, so good to see that turning around. Our power, labor, consumables, and other has increased, as said before, and we can see that our all-in sustaining costs also increased, and that's pretty much due to an increase in our share price that increases the share-based expense. So that's actually a good cost to see, as our investors would be happy with the increased share price. We've revised our cost guidance for 2024. On-mine cost guidance is now set at $950 to $1,050 per ounce, and all-in sustaining cost is set at $1,450 and $1,550 per ounce. And that's increased predominantly due to the labor and the power costs, which we'll come on to in a bit. So these are our cost control initiatives. Firstly, power. We're about 2 weeks away of installing power factor correction equipment. That's expected to save approximately $1.3 million per annum, and that should take effect in 2025, for the full 2025, being installed in a couple of weeks. We are planning to convert our central shaft winder from AC to DC, and the efficiencies that you gain from a power use perspective will also decrease your cost by $1.2 million. Now that would be implemented within 2025, so you'll see the full effect of that coming in 2026, and part of it coming in 2025. What we've already done is to increase our hoist payload, hoisting speed, and improved the sequencing of our hoist at central shaft. And that's helped us to increase efficiencies in our operations, and that's already taken effect. So it's good to see that coming in place. And we also plan to replace equipment with more energy efficient equipment, and that will come through in time. It's not something that you'll see immediately taking effect, but we are looking at more energy efficient equipment. Then from a solar plant perspective, we're looking to get an external party to build a phase 2. We expect that to be approximately 8 megawatts, and the rate that it saves would save us approximately $1.6 million. Now, this wouldn't come with a capital cost for us. We'll just be buying the power from a third party, and in turn save on our OPEX. Further, on salaries and wages, we retired 106 people of a certain age and plus, at a cost of $2.1 million. That's included in other expenses, so it's not part of our OPEX, but it's expected to save our OPEX going forward by approximately $400,000. And also, in addition to that, it brings about some efficiencies that we could generate by modernizing the mine. We're planning to do quite a few IT initiatives, and and hopefully that helps with the implementation of that too. We also plan to implement a new biometric clocking system, and this would track staff at the blanket mine. So we'll have better tracking of our staff movements, see where we can gain efficiencies and time studies, and better and more efficiently allocate our staff at blanket mine. In addition to this would help with the rostering and pre-authorization of overtime. So it helps us to allocate labor better to various areas and also track that, but also look at the overtime and make sure that this overtime gets pre-approved. So we know why we're spending money on overtime. So we believe that could help quite a bit in helping to manage our staff members.
Just before Chester goes on, so of those initiatives, some of them are very close to being implemented. Some of them will be implemented next year, and we can quantify the benefits arising from those, and we're pretty clear on the timing. Some of the things, replacing old equipment with more energy efficient equipment, the benefit we can get from the introduction of the biometric clocking system. At this stage, it's too early to quantify the benefits that we might reap and also the timing thereof. But we should start to see some progress from in terms of cost reduction from early next year. So go on, Chester.
Yes, so the gross profit, as I said, it's gone up by 37%. I'm very pleased with that. Net foreign exchange losses, that was quite significant. In the quarter, we incurred $3.1 million of foreign exchange losses. 800,000 of that would be intercompany foreign exchange losses that are not eliminated. That's also unrealized, and we don't expect that to realize. So I'm not too concerned about that. That's due to the strengthening of the rand. So really not an issue there. But what we see is $2.3 million worth of losses in Q3 due to the devaluation of the ZiG. We'll get down to the detail on how we manage that and how that is broken down. But for the year, we've suffered in total an amount of $9.3 million worth of loss. Now that's significant for our business, and we can no longer ignore that and say it's not a cost related to our business. We've seen this in every quarter throughout, and we've also not counted that back for our adjusted earnings per share. So we look at this as quite a serious cost, and we try to mitigate the effects of devaluating currencies as far as we can. We'll get onto that in a moment. Under other, that's where we include the once-off $2.1 million of retirement fees. So that you won't see again. Won't be repeated, and the tax expense increased due to higher gross profits during the quarter. Here you can see the foreign exchange breakdown for the 9 months, and we've got the ZiG and the RTGS. Now, the ZiG is the new currency, and the RTGS was abolished on 5 April 2024. And you can see, I was quite pleased to see that we've got a very small cash and cash equivalents loss of about $2,000 when we had the ZiG, and that's how we manage that is to spend the ZiG. We try and spend it on efficient, or we do spend it on efficient costs to ensure that our cash gets converted to inventory that we can use at the mine, rather than keeping it in a dollar that could suffer the volatility that we've seen in this currency. In the first quarter, we had a conversion method where it locked up our cash, and that incurred $3 million worth of losses under RTGS. And other than those two, I'd say that the most significant line items that contribute to our foreign exchange would be the bullion sales receivable and your battery sales receivable. And the conversion and receipt of that cash is very much outside of our control, as we receive our cash from Fidelity when they are ready to pay. So normally that happens in about 10 to 14 days, but still in that 10 to 14 days, if there's a significant devaluation like we've seen with the ZiG, it still comes down to the, affects our bottom line in terms of losses. VAT receivable.
So can I just make a point that people may not understand? There's no market there's no properly traded liquid market for the Zimbabwe currency. the exchange rate, the official exchange rate, is just set by a committee, and it typically steps down, devalues now in big steps. So case in point would be the devaluation of the ZiG from about 13.7 to I think about 23. It's about nearly 50% devaluation. That happened in a space of a few seconds. So it makes it very difficult. The magnitude and the speed of these devaluations makes it very difficult to manage. But there's no hedging mechanism, and there's no sort of exchange rate which allows you to move ahead of the curve. Sorry, Chester, go on.
Yeah, I think that covers it. So it's our main mitigation here to prevent volatility in the ZiG and losses in the ZiG is not to have any ZiG as far as you can. So we try to spend that on efficient expenditures. What I was also pleased about is the cash generation. That's before the working capital changes. And again, we've got a quarter over $16 million for the quarter. If you see our 46 million that we've generated for 9 months, that's more than double that we generated last year. And it's good to see that every quarter this year, our cash generation has been consistent, and it's been a lot higher than 2023. So it's good to see the ship turning around from 2023 to now. Good cash generation. We have spent some money on safety stock to ensure that we've got spares available and bolster our production and not have any delays in terms of production. We don't want that, especially at the current gold prices. And we've also increased our prepayments for long lead items, and that would be reflected in the capex that comes through in Q4 predominantly. And about 1.4 million of that prepayments relate to the ZiG, where we've made some prepayments to buy stock rather than hold the cash. So that has significantly affected our cash flow, but not in a bad way. It helped us to ensure our production, get some safety spares, and also ensure that we don't suffer the evaluations in the ZiG. So it just changed form. We expect that to turn around over the longer term, and it's good to see that safety equipment on the shelves. Other than that, capex, that's well controlled. We still expect capex to come in at 30.8 million at Blanket. So no unexpected capex. There might be some that roll over into next year, but the absolute number hasn't changed, and that shouldn't affect. So happy to see the cash generated again in this quarter.
Good, thank you, Chester. Can I ask Craig to run us through the results, the Motapa results, which again we announced this morning. Craig, can I leave you to do that, please?
Thanks, Mark. Good afternoon or good morning to everybody. So basically during 2024, Caledonia kicked off a first pass, pretty widely spaced drilling program at Motapa. As we can see on the map just to the right there, we have Bilboes, which shares a common boundary. So it's, they're right next to one another. Motapa has 3 main trends. So we have basically the northern, central, and southern trend. These 3 trends in total are just over 9 km in strike length. So it's a fairly expansive piece of ground. So for this year, what our focus was, it was to test the continuation of sulfide zones below the historic open pit oxide that was mined, typically during the 80s and 90s under Anglo-American. And so clearly we have quite a bit of data from Anglo, some old drilling databases, some underground working plans from previous operators as well. And then we wanted to trench across the Motapa property to have a look for prospective new areas that might not have been found or had been looked over. So we have drilled just over, it's there, so about 9,500 meters of drilling, a combination of diamond and reverse circulation drilling. That was from a total of 68 holes. The grade in general is very, very similar to Bilboes. So again, I've just got to stress that it's very widely spaced. It's about 150 to maybe 200 meters between drill holes. So it's early days. The widths may be a little bit thinner than Bilboes. There's still a lot of work to actually be done. So, just looking at the grades, I mean, those are 6 holes of, as I said, 68. In the press release, it'll be available on our website as well. The full details are there. You can have a look through all the holes. But something that sort of stuck out is that, yes, quite clearly, sulfides continue at depth at similar grades. But of great satisfaction is Caledonia has defined an area on the eastern portion of the Motapa central trend, and we call it Mapudzi. And so it's the 4th hole there, the NPZ RC number 2. That's just one of the holes that is from there. And so as you can quite clearly see, pretty decent grade, very, very shallow, sitting at 12 meters below surface. And it does appear to be oxides, right? So oxide material. And this is quite significant in the fact that the Bilboes that we have, it currently still has 2 oxide heap leach processing plants. The closest, well, they're about the same. The one's 3.5 k's away, the other one's 3.2 k's far. So we have drilled some extra holes. They are in the tables in the press release. There are 15 holes that we actually drilled there. Sorry, 9 holes drilled, six of which have grade. And of great interest is, of all of the intersections in the Mapudzi area, 8 of the 15 intersections that we actually report with grade are above 15 meters. So 15 meters and shallower. The average of those 8 intersections is 4.21 grams per ton. And so we can drop out that high grade one of 10.95, and the average comes back at 2.6. So it's very, very exciting for us going forward into 2025 and 2026. Our focus is going to be on clearly the Mapudzi area. We are pretty sure and pretty confident that the potential for near-term oxide mineralization is there, and clearly we'd like to get that into the bank. The second focus is going to be drilling on the Motapa North area, which is directly basically along the Bilboes Motapa shared boundary, and that is about 1.5 k's from the plant. So our focus is to get that into a mineral resource of some form or fashion, be it inferred, indicated, whatever it is, and then to focus on the Mapudzi area. So I think going forward, we're very happy that we have proven up that the sulfides continue at depth, and we will execute a standard drilling program to get that onto our books, and then the Mapudzi area, very, very exciting. Thanks, Mark. I don't know if you have any comments.
Okay, thank you. Thank you, Craig. Shall we move on? Okay, just a few words about Bilboes. We continue to do work on the feasibility study, so there's no update there. All the information you see on this slide is from stuff we previously published. We still remain on course to publish a feasibility study in the first quarter of next year. And for those of you who are familiar, the main focus of the work is to upgrade it from the existing PEA to a feasibility study, is to upgrade the work that's been done on the tailings facility. Whilst that's going on, we're also now progressing our thoughts about funding. Clearly, we had some internal thoughts when we bought Bilboes. We've now had those validated by a specialist debt advisor, and we're now in the process of beginning to engage with prospective funders. We're looking at what seems to be coming into focus would be 3 potential funding structures using various combinations of various permutations of senior debt and mezzanine debt. So we'll continue to flesh those out, and then in due course, very much in the hands of the speed at which the funders move, but in due course we'd then be able to announce the senior lender and the debt arrangers. But I can't really give an indication as to how long that will be, but that's making good progress. Sure, I think moving on. So look, in terms of outlook, at Blanket, our immediate area of focus is to maintain production at about 75,000 ounces a year. And as you've heard, we do need to pay closer attention to the area of costs, particularly electricity and labour. Some of the initiatives we're taking, we're able to quantify. Some of them at this stage we can't quantify and we can't put precise timing, but we're beginning to make progress there. At Bilboes, we expect to publish the feasibility study in the first quarter, and as I've said, we are making progress on various funding options. Then, as Craig's just outlined to you, we've got exciting results at Motapa from 3 areas that were pre-known, and then from 1 new area which effectively we found, and we'd expect that exploration to continue maybe a couple of years before we get to a maiden resource. But given its immediate proximity to Bilboes, anything we find at Motapa should give rise to very substantial synergies as a combined Bilboes-Motapa operation.